Hi, this is Scott Murray, and welcome to the Daily Economic Market Shout for Wednesday, January 4th, 2023. It's great having you with me here today. And we got two important readings on the economy. First, the ISM Manufacturing, one of the most important readings we see on a monthly basis for the firms. And we also got insights on the JOLTS reading that talks about openings, quits, terminations in the jobs market for November. But let's go to the more topical one first. Yes, we're seeing firms slow down. Orders are weak. We're starting to see the customer inventories move higher, now coming to about parity with what would be expected over the long term. There had been a deficit. Clearly, higher economic activity had inspired over the last almost 3 years now the wave of purchases and to fill orders. That is gone. Production remains expanding, however, and to match that, there is less layoffs. However, employment is dropping. So there is some attrition out there in the manufacturing world, and there is some need for employees, but companies are trying to keep away from layoffs. They worry about not being able to bring employees back. So they're holding off the layoffs, but they are lowering employment while keeping production. It would be expected, particularly because we're not getting any push from the global demand, that production would start falling and equalize, and then some layoffs would occur at that point. But it hasn't occurred yet. And it's showing that even though we've had a huge increase in interest rates, the effect on the economy caused by these higher rates is not that severe. Probably what's happening out there is we're having fiscal stimulus and the strong consumer demand that keeps on pushing the economy forward. But we need to keep our eyes closed. Firms believe a recession is coming. They're stopping to orders, and that may be the catalyst that finally puts us into a mild recession caused, as we know, with expectations, particularly with the Fed. Good news was prices paid fell under 40. It had been over 90 in the middle of last year. 50 is the line between expansion and contraction, with the higher growing. So we had dramatic prices increases. Last summer, we're seeing actually price decreases. 1/3 of all firms are seeing price decreases. That tells us that the price environment is radically different, and that difference allows for lower inflation. Remember, costs going through manufacturing have a lag, so it'll be several months until we see it in the numbers, but it seems to be coming forward. Briefly on the JOLTS number, clearly openings above 10 million, still healthcare, leisure, still looking for persons, people still quitting at very high rates, still openings coming. So the pullback that we've seen in the manufacturing is not cascading through the economy, which tells us that, again, labor market is solid. We should see reinforcement of those numbers. Remember, this is a November reading. We should see reinforcement in December of those numbers that we should get in the next few days. This is Scott Murray for the Daily Economic Market Shout. Thanks for joining me.